If we look back from 2026, this moment will be remembered as the watershed moment in the AI investment cycle. We don't need to guess the future. The blueprint is already written in today's balance sheets. Based on current market mispricings, our portfolios need a surgical repositioning. Our core thesis is clear. Go long on vertically integrated ecosystems, go long on critical infrastructure nodes, stay extremely cautious on single-point hardware supplier narratives. With this in mind, I've crafted execution strategies for different risk profiles, not just stock picks, but risk parity-based asset allocation designed to capture structural shifts in the AI value chain. For conservative capital, Broadcom, the asymmetric advantage. Why Broadcom? Because it holds the asymmetric advantage in this new game. As the core design and manufacturing partner behind Google's TPU architecture, Broadcom plays the role of the toll booth on the AI highway. No matter which car wins the race, as long as traffic flows, the toll booth collects free cash flow. Currently trading at a PE of around 22x, Broadcom offers a rare margin of safety in an overheated tech sector. Trade execution. Don't chase the price. Wait for mean reversion and build positions gradually, near $345, close to the 5-day moving average. Set a strict mental stop loss at $330. This is a pure beta play, aiming to capture average industry growth with downside protection. For aggressive growth, the Google plus Meta synthetic long. This isn't just buying stocks, it's a bet on the entire AI value chain shifting. You're simultaneously owning the strongest supplier, Google, and the strongest adopter, Meta. Trade execution. For Google, look for entry near $300, a key technical support level. For Meta, watch the $600 psychological level. Risk management. Use trailing stops. Raise your stop loss as the stock rises. Our rule, never let a winning position turn into a loss. For passive investors, ETFs and dollar cost averaging. If individual stock volatility exceeds your risk tolerance, consider tech ETFs heavily weighted in Google and Broadcom. Alternatively, look at ecosystem players like Amazon, AMZN, which hasn't fully priced in its AI upside yet. Set up a dollar cost averaging plan and ignore short-term noise. Why the sudden shift away from Nvidia? You might be wondering, why are we so aggressively reducing exposure to Nvidia, the stock that made us rich? To answer that, we need to rewind a few weeks, to a day that even Wall Street veterans called a repricing event. The signal, Broadcom's 11% surge. A few days ago, Broadcom's stock jumped 11% in a single day. For a megacap tech stock, that's not noise. It's a repricing event driven by institutional capital. Why? Not retail hype. It was smart money digesting a bombshell report from JP Morgan. Their model projected that Google's TPU project alone could generate over $10 billion in revenue for Broadcom in 2025. Think about that. This isn't just revenue growth, it's a paradigm shift in market perception. Capital is finally realizing that Google isn't dabbling in chips, it's building an industrial-scale chip distribution network. Broadcom's surge was the market betting on the end of Nvidia's monopoly. The Great Divergence institutional flows speak volumes. This wasn't an isolated event. Throughout November, we observed a great divergence in institutional flows. The data is clear. While retail investors kept buying Nvidia, institutional money was quietly exiting Nvidia and rotating into Google via dark pools and block trades. Top hedge funds and pension managers were asking the same question in closed-door meetings. How long can hardware margins last? Where's the next growth engine? Their algorithms answered, sell the old king, buy the new one. Capital is shifting from pure hardware manufacturing to self-sustaining platform logic. The great betrayal, Meta's nuclear move. The catalyst? Meta's decision to spend billions on Google's TPUs instead of Nvidia's GPUs. This isn't about friendship. In capital markets, there's no loyalty, only capital efficiency. Let's break down the tech and financial logic behind this betrayal. For years, the market believed the most powerful chip wins. That's linear thinking. In hyperscale data centers, the only metric that matters is total cost of ownership, TCO, per unit of compute. Nvidia's H100 is a Swiss Army knife, great for graphics, training, inference. But that versatility comes at a cost. Over-engineered architecture, high power consumption, and premium pricing. Google's TPU? It's a surgical scalpel, an ASIC application-specific integrated circuit stripped of everything not needed for AI. No graphics cores, no general-purpose logic. Just pure, optimized machine learning. The numbers don't lie. In AI inference, Google's 4th-gen TPU delivers 30% lower latency than H100. On Google Cloud, TPU workloads cost up to 25% less than equivalent GPU runs. That 25% cost advantage is a game changer. For companies like Meta or OpenAI, burning billions on compute, this isn't just savings. It's billions in potential profit, or the ability to hire thousands more AI researchers. It's a structural arbitrage no rational CEO can ignore. The ecosystem moat, Google's closed-loop advantage. But cost isn't the only weapon. Google is building something Nvidia can't replicate: a closed-loop ecosystem. Enter the concept: software-defined hardware. Nvidia's model is selling shovels to gold miners. It depends on customers building profitable apps. If the apps fail, shovel sales dry up. Google? Google is the gold miner. It owns the world's largest app ecosystem: Search, YouTube, Android. With Gemini AI embedded across these platforms, every user click, every search, feeds data back into improving the next-gen TPU. This creates a flywheel effect. Users, data model optimization, better TPU design, better apps, more users. Google doesn't just use the best shovel, it designs it, tests it, and now sells it to other miners, like Meta. The financials confirm this. In Q3 2025, Google's AI-related revenue surpassed $20 billion, with a 68% gross margin. This isn't just revenue. It's proof that Google has cracked the end-to-end business model. Google is executing a triple harvest strategy. Hardware layer, selling TPUs to Meta and others. Infrastructure layer, renting TPU compute on Google Cloud. 3. Application layer, using AI to boost ad conversion on Search and YouTube. Meanwhile, Nvidia faces headwinds. Rumors of H100 inventory buildup are emerging. Rising inventory days are a classic red flag in hardware. When your biggest customers, Meta, Amazon, Microsoft, start building their own chips or switching suppliers, your growth ceiling becomes visible. The macro backdrop, the Fed's pivot, all this plays out against a major macro shift. Back in mid-November, Christopher Waller, one of the Fed's most hawkish members, signaled a policy pivot. Interest rate swaps now price in an 81% chance of a December rate cut. This isn't just a possibility, it's nearly certain. What does this mean? The floodgates of liquidity are reopening. For 2 years, high rates made capital expensive. Investors sought safety in cash-generating shovel sellers like Nvidia, a defensive play. Now, the wind has shifted 180 degrees. Lower rates mean capital is turning greedy, chasing higher risk premiums. Money is moving from one-time hardware profits to platforms with exponential growth stories. Think of it this way. For 2 years, a storm raged. Everyone huddled in Nvidia's sturdy brick house. Now, the storm has passed. The sun is out. Investors are leaving the house to build new cities. Google owns the land and the blueprint. Add to that, easing U.S. China tensions have reduced tail risks for global tech giants. The macro environment has shifted from defensive to offensive, fueling the capital rotation we're seeing. History repeats. The Nokia moment. Let me end with a historical parallel. 20 years ago, Nokia was the undisputed king. Its phones were tanks, unbreakable, with perfect call quality. Like Nvidia's H100 today, best-in-class hardware. But when Apple launched the App Store, the game changed. The value shifted from hardware specs to ecosystem power. Nokia didn't lose to a better phone, it lost to a higher dimensional business model. Today, we're at the same crossroads in AI. Nvidia is still strong, but it risks a Nokia moment. If it can't evolve beyond being a hardware supplier, it will be outmaneuvered by full-stack giants like Google. As investors, our biggest enemy is recency bias, the illusion that last year's winners will always win. That's psychologically comforting, but financially deadly. True alpha comes from exiting old narratives before they peak and positioning in the new ones. AI's first half. Who has the best weapon? Nvidia. AI's second half. Who has the best targeting system and ecosystem? Google. The captain is changing. The question is, have you changed your ticket? If you appreciate this data-driven, emotion-free analysis, please like and subscribe. In the comments, are you holding Nvidia's old fortress or ready to embrace Google's new ecosystem? Stay rational, manage risk. Until next time,